What's going on, guys? So in this video, I'm going to be going over what the Morgan Stanley Chief Investment Officer had to say about the market, particularly relating to growth stocks and, the higher flyers, in the investment space. And I'm going to kind of give my interpretation of what exactly he was trying to say, on the CNBC. Obviously, going to news outlets, especially for investment-related things, normally, you have the talking heads on the board, and they just kind of garble the same type of rhetoric over and over again. And it's really like occasionally you'll get like a nugget of like semi-useful information, but really the only useful information you get from news is when, actual investors come on board and they kind of talk about their ideas. And obviously some of them are right, some of them are wrong. But it's just kind of breaking down, their thought processes and really seeing like how they're looking at the market, especially, someone who's high up in Morgan Stanley. He, at the end of the day, is a market mover, and I'll get into that in a second. So what these people have to say, you should really just kind of pay attention to. Either see what they're actually feeling or see what they're trying to sell the market and see like what their actual schema is and going forward. So for those of you that are new, my name is Dan, and this is Millennial Investing. I just kind of go over, finance-related topics and, what I'm doing with my portfolio and what I'm doing, in the market and my investment ideas. And I'm really just kind of documenting that on YouTube, kind of help people out. So, if you guys are, new to investing, like investing in, like, say, tech or growth, definitely stick around. I tend to do, stock reviews, portfolio updates, things like that, and give my opinions on, mostly tech-related things, but also really focused around growth. And so in this video, I just kind of really want to break down what kind of this means for, investors like such as myself and probably most of you that are invested in like, the high flyers that, are experiencing massive growth, but in the past week or so have been experiencing a lot of volatility. So, kind of start off like the, just the basics of what this investment officer from Morgan Stanley went over. Is kind of talking about how, in this past week, the S&P has dropped and, the information technology space, especially software companies, have dropped significantly higher. And a lot of people, panic sell. A lot of people, immediately go and buy in the dip. And it's kind of, I just wanted to kind of shed light on exactly what is going on, at least from this Morgan Stanley investors, mindset. So the way that he kind of breaks down in the interview is that you have to look at that the tech space is showing possible signs of slowing growth. And, that's been, just from a couple of companies over the past few weeks. It's earnings season. Everybody's kind of on edge with like, okay, how is this going to go? Netflix will be coming up soon. And, depending on what Netflix does could be a major, kind of direction for major, like for especially all the FANG stocks, but all the other like, high-flying software companies. And so the general consensus is that a lot of tech is going to start slowing, and that's due because, they had such an amazing year the past year and a half. A lot of, their possible market share has been captured at this point, at least, so they won't be growing at like, say, like the 30-40%. They'll probably grow at like 20 to 30%. And this is kind of just what the market's reacting to that anticipation. And so the points that he brings up are kind of interesting. So he brings up how the majority of like, say, if you look at like tech companies or you look at like consumer discretionary, you look at all these companies that are generally extremely profitable during a, bull market, a profitable time in the economic cycle, when they do well, when the market does well, they do extremely well. A lot of these companies have been buying back shares. And so when you look at that from a long-term point of view, it's really not ideal. And he kind of points it out quite elegantly. He talks about how, okay, so you have your earnings going up and, you don't have a lot of actual assets. And so you're making a lot of money. So your share price goes up and you might have a moderately reasonable PE, or your PE is extremely high, but your growth is high enough that the majority of people, can justify paying that premium because they expect their growth to continue. But at a fundamental standpoint of what like the shares are actually representing, it seems a bit inflamed. And this is the time that these companies are using, either debt or cash flow to buy back shares. And that causes, a couple of issues, but the main one that at least this analyst sees is that it causes illiquidity in the market. And so what you have to keep in mind is that, so like say if you have a company that has 100 shares and they announce a 10 share buyback, so they're buying back 10% of their shares, assuming that there are, 80 plus shares out in the market, all of those shares that, individual investors have, once they remove it and say they have 80 out of, they go from 80 out of 100 to 80 out of 90, you own, like per share, you own more of that company. So when you buy or sell a company, you're moving the company in a bigger format. And so that mainly plays a role with people like hedge fund managers, because hedge fund managers that say started a 10% stake in, say, Netflix years ago before it took off, assuming they still had their position, most of them probably don't, but assuming they did, any time that, they do a massive amount of, like, say, share buybacks, that company, the value of their shares goes at an exponential rate. And so whenever they want to sell, lock in these even higher gains, it's going to move the stock in a much faster way because there's not a lot of shares being exchanged in comparison. And everybody that's selling, is selling, say, a bigger portion of the company for whatever price. So that's something that kind of, really piqued my interest because I do think that is a big issue that's going on because a lot of companies are doing buybacks right now. And, just kind of looking at it, what has exactly happened in the past week, since I think I looked at October 3rd, the S&P at its peak dropped down, about 6.5% to its trough the other day, last week. And then the Information Technology Index, the Vanguard one, dropped 9.8%. So you can think about that in the sense that these tech stocks that are generally like, software-based companies or, any like high flyers, like look at NVIDIA, look at Microsoft, things like that. These companies generally fall at about 1.5 times the normal rate of the market. And that kind of plays to the tune of a lot of people are, getting more and more hesitant about, okay, you have lower unemployment in the market, you have higher yields and interest rates, and you're in the later phase of an economic cycle. Odds are these people are getting pretty testy that have been riding growth stocks for, a couple of years at this point. If people got in just last year, most of them are experiencing 40+% returns in a year. And, if you've been around investing for a while, that is an unbelievable return. And the majority of people don't want to see that go away. So the majority of people that say invest in these growth companies, the second that growth slows down and they see the market start tanking and they see their returns start to evaporate, a lot of people are going to start panic selling. And now while you might be extremely long in the company and you might say like, oh, well, it doesn't matter in the short term, you have to realize that is, like when the market goes down, there's a reason why, fear and greed play the biggest roles in the market out of anything. You have to understand that if we continue to have a lot of volatility, tech is only going to have a magnified volatility of the overall market. Last year we had one of the least volatile years in history, and if you went long on tech, you did amazing in the market, and you destroyed pretty much every other benchmark. Like if you were lucky like me, and you went long and you had great returns, but you have to understand that isn't to be expected, this year, next year, and so on. As we can already see, just from back in February and in October, the market doesn't play like that, at least not often. So you have to really look at let's look at high growth stocks in general. So high growth stocks, ideally, you would want to sell off into a bull market and you want to buy into a bear market. And now, obviously, that's not as simple as it sounds. Obviously, no one can time exactly the peak of a bull market and the trough of a bear market and, buy and sell accordingly. Otherwise, everybody would do well. But you really have to focus on what happens with growth stocks. Growth stocks magnify what the market does, essentially. So when growth inevitably slows, you have to realize that market movers, aka the hedge fund managers, the people that are controlling, $500 million portfolios, $5 billion portfolios, all the way up to, say, I guess technically Warren Buffett, with a near $500 billion portfolio. These individuals are going to decide what the price of shares are, or of stocks are, and how many shares that they want to buy and sell. And, retail investors are a minute portion of how much, power they have with buying and selling a company and making it move. If you look at a company like Apple with over $1 trillion, in order to get Apple to move, you're going to be needing to move, tens of billions of dollars to just get a couple of percent. And a retail investor, I don't know about you, but I don't have a couple $1 billion lying around. So if I see, Apple starting to go down and I'm like, oh, that's not justified, I'm going to buy it, chances are Apple's going to continue to go down even though I bought, say at 100 and it moves down to 80. So you really have to think about, okay, these market movers, they have a financial background, they've been in the market, for multiple market cycles, and they have, shareholders that are constantly looking at what they're investing in, and, if they don't like what they're investing in, they're going to pull out all their money. So at the end of the day, financial experts, they come up with all these fancy things, and they say, like, this is my valuation of the company and why I have it. In a bull market, no one really cares. Everybody wants the high flyers. But when a lot of the guys that are just kind of throwing money in at the wind and seeing what happens, and you start getting, the more people that are like, I want concrete returns and yada, 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 they start to take the, the value investor approach as opposed to the growth investor approach. And, the ratios and the fundamentals become much more important. So, like, you really have to focus then on the PE, the PEG, the PB value, the debt to equity, and then the discounted cash flows of your individual investments, along with your moats and everything else that's going on with the company, to really see pretty much where your stock's going to stop. You can have a high growth company, and there are companies that have been high growth, like look at Apple. Apple has been a high growth company for multiple market cycles, but just because it was, high growth now doesn't mean it's going to be high growth later. And, if Apple didn't have an amazing balance sheet, it would have a very, hard time, as it did, 20 years ago. It would have a really hard time trying to stay afloat, once, either its earnings drop or its debt is due, things like that. So you really need to keep that in consideration, especially investing in growth stocks, with kind of what's going on in the market. And that's kind of what that Morgan Stanley investment officer was kind of talking about. And so I kind of wanted to just make a quick, check sheet for people just to kind of look at and, kind of double take and look at your portfolios and see kind of what's going on. So assuming you think that the markets are going to continue to be volatile and, you think that, we're near the end phase of a bull market and that, we could go up another, say, 20%, but we could also go down 50%. So your risk reward isn't as great as it was, say, a year or two ago. If you believe that, it might be wise, to start looking into alternative investments or adapting your investment strategy. There's no, fault in doing this. And generally, if you do it intelligently, you can still make money no matter what's going on in the market. So you can look into commodities, defensive sectors, so utilities, consumer staples, and sin stocks. Longer term options, so you can do either put or call options. If you guys don't know how to do options, I can make a video about that later. Essentially, that's a really easy way to hedge your portfolio with, you're essentially betting on a company going up or down. And, you can either lose 100% of your money or you can make multiples of your money. So it's a really interesting way to either lose a good amount of money or make a lot of money off of a small amount of money. And then inverse ETFs. You guys know I've been, kind of slowly accumulating a position in the inverse emerging market ETF, mainly because the emerging markets are in a bear market, and until that trend reverses, you can just assume that it's going to continue. That's more of a trading logic than it is investing logic, but with allocating 5 to 10% of your portfolio for shorting, that's kind of what makes sense, at least to me, is you want a long short portfolio. You don't want only a long portfolio in this stage of the market. And I'll link to these channels down the comment section below. And these are kind of for the people that are, like me personally, I am, I'm still young with investing, and I'm kind of reevaluating like what exactly investment strategy I want to do, for my investment career, or if I just want to switch my investment style depending on the phase of the market. Who knows? But these are my favorite financial YouTube channels here, and they all kind of have different flavors for what type of investors they are. So depending on what type of approach you either want to, turn your portfolio into, or you want to start taking, like, say, different approaches into individual positions in your portfolio, I highly recommend all of these channels, and I'll link to them all down there, down the section below. They all have larger channels than me. They've all been, around YouTube for a while. Most of them I've seen, because I follow most investment channels here on YouTube. Most of them I've seen from the beginning of their YouTube channels to like where they are now, and some of them have grown exponentially, and I'm extremely happy for them. But they have amazing value, and I kind of, if you guys have found my channel and you don't know these channels, highly recommend checking them out, because they have many more years behind them of like seasoned investing, and they really cemented their, individual way of investing and whatever worked for them. And that might work for you more than, say, what my tech-based investing does. So first off, Sven Carlin's channel. Sven Carlin, amazing value investor. I followed him on Seeking Alpha, a year or two ago, and then he started a YouTube channel, and it was so much easier for me to, keep up to date with his reviews. Really, really in-depth and really valuable YouTube channel, especially for value investors. Highly recommend it. Michael J, again, he's closer to my age, so he probably doesn't have as many years in the market as a couple of the other people here, but he really goes in, he really goes really deep into his stocks. He explains why, and he takes also a value investing approach, and he's very methodical and analytical with his approach to investing, and I believe he kind of breaks that down, at least from what I've seen from the majority of his viewers' reaction to it. It's very easy to digest, and people understand why he's taking the approach he does. There are a couple of picks that he's pointed out that I've actually found to be very interesting plays that I might, start a position in with further research. So highly recommend his channel. Spicier Capital. So Steven Spicier is, certified financial planner. Amazing resource here on YouTube. Focuses mainly on value small cap companies because statistically, if you invest in small cap companies properly, you have a significantly higher return than the average market, especially investing in large caps over the long term. I have dabbled slightly with small caps. Still not really my cup of tea. I don't know. Something about it, it just doesn't sit right in my head. I know fundamentally it's the exact same thing, approaching a small cap to a large cap. But I don't know. I just haven't gotten comfortable with it yet. However, Steven does an amazing job at breaking down all of his investment ideas and really packs a lot of content into his viewers. So I highly recommend it. If you want to take a defensive approach, looking for dividends and stocks that are consumer non-cyclical, definitely look into PPCE. He has been an investor for, I think, 20 years now. He invests in companies for cash flow and mainly cash flow only. And he has a very unique investing style that has worked for him. And he's kind of redefined it over the years. And it has proven very well for him. He's a great guy, really informative. All of these guys pretty much go back and forth with their, subscribers in the comment section. So definitely check him out. And then if you want to continue, growth out of value or technology research, I guess you could continue watching my channel. I mean, I'm relatively new, but I do have probably the most extensive tech background out of most of the investors on YouTube. So that's kind of where I'm trying to find my niche. But again, I have a much higher tech background than I do investing background. So take that with what you will. And then obviously, financial education, biggest investment channel, or purely investment channel here on YouTube. Ryan Scribner also has another big one. But Jeremy, I followed Jeremy since I think I started watching his channel at around 3,000 subscribers. And he has just exploded with the amount of content he does. He does daily, stock market news. And while I don't agree with all of his picks, Jeremy is very, he's very, he has a lot of conviction with all of his investment ideas. Obviously, he's, as I've said, he is much more optimistic than I am in the market. But, as of say last year and a half, more optimism has outperformed. So, I can't say he's wrong. No one can say that anybody's really wrong with investing. He takes a different approach than I do with kind of the same, niche. And I highly recommend, just following along to see what he has to say. And, all these guys, if you follow all these guys, you get a very diversified opinion of the market. So with that being said, this video is already long enough. So I hope you guys liked this video. Hope you guys found some cooler resources if you guys haven't already been following these channels. And I hope I kind of introduced enough of a topic, of growth stocks and what's going on in the market right now, what could possibly happening to a lot of you, especially those of you new to the market. And so if you guys like this, or if you guys want me to go into any of the topics that I've gone over here in more, detail, make sure to let me know in the description down below, and I will catch you guys in the next video. Peace.